Welcome to the Deep Dive.
Glad to be here.
Today, we're really going to try and cut through some of the noise around recent fund at Mental Insights.
Yeah, there's a lot happening at that intersection of global finance and geopolitics.
Exactly. So our mission is to highlight the critical takeaways for you. We'll just go through each source one by one.
Sounds good. Let's unpack it.
Okay, first up, the source called New Highs. The S&P 500 hitting all-time highs recently. It even recovered that Liberation Day dip.
Which is fascinating, right?
Totally, especially when you see Q1 GDP was revised down to minus 0.5%, and trade talks are still, well, ongoing.
It really makes you question what's driving it.
Doesn't it just, is the strength real?
Well, that's the thing. The analysis suggests the market's internal breadth, as they call it, isn't great.
Meaning?
Meaning only about half the stocks are above their 200-day moving average. That's, well, it's not a sign of really broad strength. And you've still got the persistent deficit and debt issues lurking. So this strength seems quite tied to maybe the U.S. muscle flex against Iran, and certainly the president pushing Powell for lower rates.
The momentum going.
Pretty much.
Right. That leads us nicely into the central bankers' frenzy, because it wasn't just the U.S., was it? May and June saw central banks globally leaning dovish.
Overwhelmingly dovish, yeah. Brazil was the main exception. We're talking a huge injection of liquidity worldwide.
But it's a bit unclear why exactly. Are they fighting deflation, or is it worries about an economic slowdown?
That ambiguity is key. And this liquidity injection is massive. If you look at the Fed specifically, after their FOMC meeting, the odds for a September rate cut just jumped.
How high?
Above 70%. And you even have some voting members saying, hey, let's do it in July.
Yeah.
Echoing the president, right?
Yeah.
Lower those debt costs.
So what's the risk versus reward here with the rate cuts and maybe the OBBB bill passing?
It's a double-edged sword. Could inflation come roaring back very quickly? Yes. But on the other hand, it might be seen as a way to help manage that enormous deficit and debt load.
Okay. Now, Jerome Powell himself, the source, Wait and See, covered his semi-annual report.
Ah, yes, the official stance.
He was pretty clear, wasn't he? A wait-and-see approach. He thinks it's too early to cut rates, pointing to policy uncertainty.
Which, of course, just keeps that presidential pressure cooker on high.
Naturally.
And it's a tricky spot for Powell. His term's up next May. You're already seeing a couple of Fed voting members kind of positioning themselves.
For his job?
Seems like it. Advocating a, let's say, more dovish, Trump-pleasing approach.
Interesting. But for now?
For now, July cut odds are still low. Powell's been consistent. But, things like tariffs and new conflicts, that could definitely force his hand on the timing.
Speaking of conflict, let's turn to entanglement. This details the U.S. getting more involved in the Israel-Iran situation.
Right. The stated reason being Iran's uranium enrichment levels. Too high for peaceful use, supposedly.
But the intel reports don't actually confirm they're building a bomb, right?
That's what the source says. No factual confirmation. And meanwhile, regime change is being talked about widely in the news. Maybe that's the real target.
And the fallout.
Well, broader implications are huge. The initial attack cost something like $2 billion. And the potential outcomes, retaliation, regime collapse, neither is peaceful.
And oil.
Big impact potential.
Yeah.
Iran's got, 13% of OPEC production? Add refinery attacks, those rumors about the Strait of Hormuz closing.
It makes you wonder.
Yeah. Is it partly about pressuring China in the trade talks? Or does it risk pushing Russia, China, and Iran closer together? Big questions.
Then came no panic moves. Iran's parliament actually did decide to close the Strait of Hormuz.
A major escalation on paper.
But look at the reactions. Putin said no help for Iran, citing Russians and Israel. China called for a UN council meeting, kind of quietly.
Muted, yeah. And Iran threatened to leave the Non-Proliferation Treaty.
The NPT, right?
It really echoes, unfortunately, the whole Iraq WMD situation.
Yeah.
Unclear intelligence leading potentially towards regime change.
But the markets?
Surprisingly calm. Equities flat, bond yields actually went up a bit, dollar stronger, oil only modestly higher.
So the takeaway is?
No panic moves.
Yeah.
No escalation discounted. The market just isn't pricing in a major blowup right now.
Okay, shifting gears slightly. NATO revival. A big summit in The Hague.
Right, the new spending commitments.
NATO leaders officially committed to hitting 5% of GDP on defense spending by 2035. That's broken down into 3.5% core defense, 1.5% on related stuff like cyber.
The sheer scale of that is, wow. We're talking a cumulative need over 10 years of about $8.4 trillion.
Trillion? How do you finance that?
It'll almost certainly be debt financed. which points towards higher yields down the road.
And the deeper implication.
Well, the slightly provocative thought is, when you invest this much in weapons, it often suggests you might intend to use them. More conflict potential.
A strategic signal, perhaps?
Absolutely. Seems like the U.S. and allies flexing their military capabilities, maybe with an eye towards China.
Okay, last source. Waiting on the world to change. This one notes President Trump seeing the Israel-Iran conflict as basically over.
For now, anyway. Probably more like a temporary ceasefire.
And back home, that OBBB drama, the big fiscal bill, is still stuck in the Senate. No clear timeline.
Right. And the bond market. It might not like it if OBBB actually passes, especially if the economy is slowing down. Leading indicators are showing some modest weakness.
So Powell might use that.
The expectation is he might present a kind of stagflationary scenario, sluggish growth but sticky inflation, to justify keeping rates where they are, around 4.25, 4.5%.
And the market is just waiting.
Essentially, yeah. Waiting for a clear signal before making its next big move.
So tying this all together for you, our listeners, we've seen these really complex links, haven't we? Central bank money, rate debates, Mideast tensions, NATO bulking up.
It's incredibly interconnected.
What Fund at Mental's insights really highlight is how global markets are just deeply tied to political moves, strategic plays, often in ways you wouldn't immediately expect.
It's a fascinating and maybe slightly unnerving picture. Which leads to a final thought, perhaps.
Go for it.
With all these interwoven tensions, the geopolitical friction, the economic shifts, these huge piles of debt building up globally, what historical parallels, what past events might give us the best clues about where we're heading, towards stability or something else?
Something to definitely ponder. A great point to end on.